Hello everyone and welcome. It's a correlation webinar. We have done this in the past. We have seen some correlations, some of the most famous one, but today we're going to be a bit more in depth about this concept by reviewing other than the very famous correlations that there are in the market. I'm referring to particular assets between them and etc. But today we're gonna see also correlation between news and particular currencies, bonds, and particular other bonds with stocks, bonds with currencies. These kind of correlations and why they are so important. Of course, we're going to go through commodities, equities, trades, and takeovers impact for the Forex market in general. Anything that you have to have in mind in regards to interconnected events or markets in the financial market industry and the financial market world. So, as usual, this webinar is recorded, so anyone that cannot stay for the full length of the webinar, don't worry, you're going to get an email with the recording. Always check your spam folder. Sometimes, unfortunately, goes to the spam. If you haven't received anything for any reason, I don't know, it might be technical reason, etc., don't hesitate to contact our support team or the webinars, send an email at webinars@hfm.com. So a quick question, guys, as usual, just to make sure that you can hear me and you can see my screen. And I just noticed that you cannot see me. I will share my webcam as well right now. So just a quick yes on the, hi everyone, it's been a while, sorry. So as I was saying, oh, nice background. Please a quick feedback in regards to whether you can see me, hear me, and etc. We see you here. Thank you, Zoran. As usual, you are the very first to comment and help me with this matter. Thank you very much for that. So let's do this. Risk warning. Yep. Sorry, I was off for 2 weeks and I lost a bit. So this material provides a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing indication of past performance is not a guarantee or reliable indicator containing indicator of future performance. Users are acknowledged that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk for which the user is solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trade in leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. All the legal documentation, risk warning, and etc. are on the website. Feel free to find them too if you want. We have everything on other than the full risk disclosure. We have all the legal documentation on the website, so please visit it. A quick question: because I have builders outside, can you hear them? Can you hear any knocks, any kicks, any disturbing noise? Sorry. If yes, let me know and I will close the window. So correlations, this is what we're gonna see today. So not only correlations between two assets, but also the correlations between data and particular assets, bonds bonds. Bonds, guys, have been from retail traders. That's, yeah, I'm not sure how true is that, but it's what I feel, at least. From retail traders, they are being a bit ignored. But that shouldn't be the case, because they are a good indication of how the dollar could be no, perfect. Thank you, Lanka. Where is the handout? Good question, Brian. I'll post it right now. So as I was saying, bonds, I feel that they've been ignored from retail traders, especially newbies, but that shouldn't be the case, because as I keep saying, at least in my colleagues over here, and sometimes in my live analysis, I think Stuart as well, bonds, treasuries are the indication of how the correlated currency will move. So for example, US treasuries, depending on how the US treasuries will move, you're going to have an indication for the US dollar and in general the whole economy. So if I had to prioritize, those should be the top on the pyramid. Okay, so I'm gonna see some examples, old ones, but it's just for you to just comprehend and remember the correlations and how you can actually trade based on the market correlations. Even though I believe, because I can see very, very familiar names over here, I can see that the people that have commented, at least Zora and Brian, like, you are experienced, you can be consider yourself at least intermediate traders, so I'm sure that you're already using this knowledge or the correlation metrics, percentages, and etc. Correct me if I'm wrong. So let's start with what is, because we have some new people here as well. Not many, but new people here. So let me start with the basics. Explaining what we mean by market correlations, okay? And why they matter, obviously. Market correlation is, according to the name, I mean, it doesn't, correlation, connection, relationship between two or more markets, assets, events, and an asset, anything that could affect two things. One thing could affect the other. So correlation, if we take it the theoretical part of it, is a statistical measures that determines, right, how one thing affects the other, how much it affects it. So in this case, in financial markets, is how it measures how an asset, let's say dollar, I don't know, just or let's say Aussie, how Aussie, Australian dollar, could affect gold price, for example, or oil, the Canadian dollar. And for many others, I just use some famous ones, okay? So how is the measure of a general market correlation between two or more assets, or the broad market to another market? So like I said, bonds or treasuries and stocks, or treasuries and US dollar, EU bond and euro, okay? So it's a percentage usually, okay? Don't know how many of you are using AutoChartist, but in AutoChartist, for example, where's my, let me just, I had my AutoChart, yes, I had it somewhere, yeah, here it is. So the AutoChartist, for example, and in the most of the softwares, websites, whatever, expert advisors, etc., that they present correlation, it's as a percentage. It's measuring a scale. Okay, it is percentage over here, but you can see negative and positive. Okay, so that shows you the direction. By saying direction, not the direction of the asset, the direction of the correlation. So if if we say that we have a positive correlation, okay, I will come to the metrics later on. It's just to show you that is from, it could be negative to positive, okay, from minus 100 in this case in the correlation metrics of auto charts to plus 100. So if we see 86 over here, plus 86, that means that there is a positive correlation, 86%, which is huge, which is a good, strong correlation between euro dollar and pound dollar in a daily time frame, right? Because I have a daily time frame. So there is a strong correlation in the medium term between these two assets. Okay, I will leave that behind for now. So it's the statistical measures that that presents that determines how assets move in relation to each other. So other than that, you know that the markets are affected by announcements, by data from big central banks, by data from governments, by politics, geopolitics, and etc. So this is another correlation that we should have in mind. That's why we are saying, guys, that the very first thing that you have to do before you check your platforms every morning is to check what kind of data, economic data, that will be released today. So for today, for example, we have US consumer confidence, which is a very, very, very important release for the United States, okay? Because it simply presents, captures, let's say, the level of confidence that individuals have in the economic activity, okay? So it shows, it stimulates economic expansion, whether it's high, is low, whether the economy is in a downtrend. Okay, so it's a very important data release. This is the one. Other than that, okay, we have the Microsoft and Alphabet and Verizon and earnings report tonight. So these are, for example, the earning reports are correlated with the stock market. If a company reports a very pessimistic report for its first quarter, I mean, lower profits or loss, or I don't know, lower EPS, lower sales, etc., you can understand that this will have a negative effect in its stock price. This is a correlation that earnings reports every quarter have an impact, positive or negative, on the stock of that particular, on the shares of that particular company. Now, that's a different. Let's take it step by step. So the event as such, I mean, the announcement, the release of the consumer confidence today, etc., we could claim that it cannot affect the market. Yes, as such, the news cannot affect the market. But market, let's not forget, market is all about sentiment. So how the people, the market participant, will understand the release, whether they will they will comprehend, understand what the data is signaling for the economy. It will be interpreted on how they will, on whether they will buy, sell, and etc. the related asset. Sorry. So correlation between fundamental news, data releases, and announcements can be used. The correlation between data of every government, etc., central bank, etc., or even earnings reports, which are data. The correlation that they have with the markets can be used to gain perspective on the overall nature of the larger market, or to measure the amount of diversification among the assets in portfolio. So you see, in very, very simple words, if we were talking only about data, for example, the US consumer confidence today, it will affect dollar, right? It will give us an overall view of the US economy and where we are, or how it could, whether it will, whether we're gonna see a worsening of the economic growth or a pause of the economic growth, and etc. This is what we're expecting to see from the consumer confidence. But this, because the US data, it will affect immediately the US stocks and the US dollar, right? So knowing the correlation, it will help you to identify currencies' possible direction. Because think about it, it's very, very simple. I think the most of you are aware of it because you're not newbies. So, sorry, yes, you're not newbies, so I think it's a common sense for you guys. If the data are good, suggesting strong economy, that is boosting the currency higher. If they are negative, they miss expectations, they show a deterioration of the economy, an economic downtrend, etc., and spread fear, that could be negative for the currency, and we could see the currency falling, etc. The same stands for any single data release for any country. So I don't want to spend a lot of time on the fundamental analysis, to be honest. I think it's crystal clear. So it's not only consumer confidence today, but it's general. All the important economic releases you can see in the calendar. Let me just show you the calendar as well. So in the calendar, you can see that there is this bar over here, red, orange, yellow, and etc. The red are the most high impact events. They are the ones that they tend to affect significantly and strongly the related asset or the related, or in general, the market. Yeah, so let's move on. If you have any questions so far, let me know, okay? Yes, I will just, okay, this is a very, very briefly, okay, this is example. Okay, these are wrong, obviously. The interest rates are wrong, are not the current, but the higher the interest rate, okay, the more the appreciation of the currency will be. The lower the interest rate, the more the pressure on the asset. This is the overall view, okay? I'm not referring to intraday responses, okay? So I have more examples over here. How unemployment could affect the currency, how GDP could affect the currency, how retail sales could affect the currency. What you should have in mind is that any data that shows pressure on the economy, decline, for example, if a country posts an increase on the jobless claims, or for example, you know, if we have unemployment rate increases, so more and more and more people are getting unemployed, they cannot find a job, they don't have an income. This is a bad economy. This is a weak economy. So that has the pressure on the particular currency. So I will keep going. Okay. So other than fundamentals, the data between the assets. We'll go through the basic and the most famous or the most strongly correlated relationships that we have in the market. So I mentioned, so where there are correlations between bonds and currencies, commodities and currencies, equities and currencies. Okay, so we're gonna go through them in a second. Just very, very briefly from this slide, okay? I would like you to I will just highlight, I don't highlight, make this clear, just because I don't know how many of you are experienced traders. Just to clear that when we mean positive, when we have or see positive correlation in every time frame, okay, then that means that the two assets are moving on the same direction. If they are going down, they are both going down. If they're going up, they're both going up, and etc. If we have negative correlation, that means that if one is going up, the other one is going down. If the other one is going up, down, the other one is going up. This is the negative correlation. So when the price of two or more markets move together in a positive or negative way. Okay. Some of the most famous correlations, positive correlations at least, are Australian dollar with gold, because Australian dollar is one of the biggest, actually is the number one exporter of gold, oil and Canadian dollar, New Zealand and gold as well, Aussie and Kiwi together. Whatever happens in that region, whatever happens in Asia, data release, etc., Kiwi has it tends to move along with Aussie. Or if something happens in the New Zealand economy, we're gonna see Aussie following Kiwi as well, and they are both related to economy because it's the geopolitical situation. So that area, China, Australia, other than the fact that they are in the same area, let's say geographically, they have a very strong trade correlation with a relationship. What I mean, China is buying from Aussie and from Australia and New Zealand. They're buying a lot of stuff. I mean, Australia, I think, exports to China meat, cotton, if I'm not mistaken. I mean, there is a very strong trade correlation, a trade relationship. That's why the data that present demand, Chinese demand, higher or lower, have an immediate impact on Aussie, gold, and Kiwi, because they are the number one. Their number one client, the Chinese economy, is their top consumer, let's say. Negative correlation. It used to be dollar yen with gold. Nowadays is not such a strong negative correlation. Stock market Swiss franc. Or I missed here staking also bonds and stocks, bonds and dollar. Actually, US bonds, treasuries, and dollar, or EU bond, the European bond, and euro. Okay, dollar index and cable, euro dollar, dollar CAD, Aussie dollar, etc. They are a bit common sense because they are dollar cross. So yeah, Nikkei and dollar yen as well. The Japanese Nikkei and dollar yen. Are you okay so far, guys? Yes, why not, Lanka? You need just to adjust your strategy, okay? Because identify the correlation is easy. I mean, we have the correlation metrics without you doing any calculations, etc. You can see for different time frames how strong or weak a correlation is. The tricky part is your strategy. I mean, you need to stick with the basic. I mean, you need to have a strategy. Okay, this is the correlation. You can trade the correlation, of course, but don't forget that risk management, right? Appropriate target, appropriate stop loss, trigger point in order to enter on a good timing. Don't forget that. These are always the case. And nowadays with auto chart is another. There are a lot of tools that they show correlation. By the way, I like auto chart. Is sorry, not auto chart. Is sorry, I confused. This is our premium trader tools matrix. So for having this, I have that one, and I amended it in a minute, 5 minutes, 15 minutes, 30 minutes. 4 hours and etc. You need to download our premium traders tools. So dear Lanka, yes, correlation, trading with correlation is a nice strategy. It's a very important strategy, a strategy that the institutional players particularly, okay, they use a lot. Okay, obviously institutional players are trading and investing in for a long term, months, years, but correlations exist also for intraday basis, for scalpers. Is one of the most common practice for institutional players for sure, but also for retail traders. The only thing that you need to be a bit careful about is that, okay, so let me just, I can see over here, if you are an intraday trader, you need to be fast, first of all, right? Because if you set this in a 15 minutes chart, obviously you need to be fast, right? So for example, I'll use, we have over here, okay, and I want not currency pairs, I want, by the way, you can add as many assets you want. I will put gold. Here it is. US oil. What about US oil? Okay, safe. So let's say gold today in a 15 minutes chart right now. Week. No, I'm not gonna use gold. You can see it's less than 50%. Actually, a good correlation should be 70% higher. Negative 70% higher or positive 70%. And these are weak. And you can see from the colors, the high correlation is with red. So there is a good correlation between US oil in a 15-minute chart and dollar Swiss. So let's see, and in a negative correlation, by the way, can you see that? Negative correlation, minus 84% between US oil and dollar Swiss. So let's see that. Sorry. So US oil, and dollar Swiss. Where's my dollar Swiss? Let me find dollar Swiss. 15 minutes chart we set. Sorry, 15 minutes chart. 15 minutes chart. Let me do both the same template. Okay, never, just I'll put side by side. So we have a negative correlation of up to 50% between US oil and dollar Swiss. What does negative correlation means? It means that they move on a different direction. So what we are seeing here on the 15 minute chart of dollar Swiss has it's been in a rally for 1, 2, 3, 4, 5. There is a bit of a correction over here. 5 consecutive sessions, 15 minutes candles. On the other fact, however, the the US oil was down. So there is indeed a negative relationship. And the fact that it shows us an 84%, that means that this relationship is still on. So if you had seen this earlier, or even now, if the momentum hasn't changed, that means that if you decide to go long on dollar Swiss, you can at the same time decide to go short on US oil. Okay, you won't be blind, right? I don't want you to be blinded, like checking the where is my dollar Swiss? Dollar Swiss. Where's my dollar Swiss? Ah, here it is, 84%. Don't want you to be blind and say, it says negative correlation 84%. I will go long and I will go short. No, you need to still do your risk management, guys, okay? See whether this rally is running out of steam or not. So let's start with the dollar Swiss, just because I see this big move. 15 minutes chart. So 15 minutes chart, I need to put my intraday setup. So what I see over here, strong bullish candle still. Could retest the pivot point of the day or the high of the day at 88.90. Stochastic is flat but hasn't turned down, so that means that there is still positive momentum. MACD is positive, and the signal line keeps pointing higher even though it's below zero. RSI is still rising. There is no indication that it's going to fall. It's still pointing higher, and there is further steam to the upside. So all these, along with the moving average, like they keep pointing higher. It means that there is still some room to the upside. So I want you to still do your technical analysis, okay? I don't want you to be blinded. Oh, okay, it says 84%. That's a good. Let's go. Let's do it. No, if you've seen that this correlation later, I mean, at the time where it already started to reach its end, I mean, it would be pointless. Anyway, you might end up with losses. So check correlation, find strong correlations, and then you do as usual your technical analysis to make sure that it's still there. I mean, there is still further room to the upside or to the downside, depending on what the correlation is presenting and where the moving the market is hitting into. Okay, so where we left this. So I have in the slides, I have more examples, okay? Between some of the most famous and popular and strong correlations that have been seen over the years in the financial industry. But as I explained, guys, depending on what kind of time frame you're interested, what kind of time frame you're using, you might see some other correlations that occur right now. I mean, like the US oil and the dollar Swiss, or as I can see over here, what we have 90% between euro dollar and negative 90% between euro dollar and a CAD Swiss in a 15 minutes chart. So in regards to this market correlation metrics, by the way, you can amend it based on the time frame that you prefer, you are usually trading, and there is also how many candles should be included in this analysis. So it's by default 200, okay? But if you're using such a small time frame, you might consider detecting this setting, okay? So yeah, for short time frames, 100 bars is way too much, because where you think it is like candles, 1,000 candles back. No, it should be detected. I usually keep it on the default unless if something bothers me, it doesn't seem logical. I mean, when I see the chart, it doesn't seem, so I amended it to double check, or I just avoid to take that entry. because I'm not convinced that it's strong and weak, etc. By the way, you can filter them as well. So you can, if you want, you can select to see only the strong ones. You don't care about the medium ones. You don't care about the weak ones, etc. Weak or none, or strong and weak, and etc. So on and so forth. Now, I have some example, as you can see. When it was, this is 1 hour example, old one, but still an example. Aussie was down. Okay, gold was initially rebound as dollar was drifting. Then it pulled back. Something happened from just something random happened. We'll see gold in the same day retreating on the gains, but gold and Aussie have a positive correlation. Okay, so they tend to move on the same direction. So that's why once Aussie was up, gold was up. Aussie down, gold down. Aussie up, gold up. Big dip, trying to recover, maybe not with the same speed, but it's still a strong correlation, and so on and so forth. Same stands with Kiwi. I explained the reasons for that. They are areas, first of all, Australia is the biggest exporter of gold. Australian economy and New Zealand economy are strongly correlated because they have, because they are neighbors, they have strong trade relationship, and etc. And that's why they move on. They tend to move in the same direction. I think that's something that you, I'm sure that you noticed, especially if you are trading in the Asia session. So this is another example. Oil and Canadian dollar. And not only, oil tends to, as we have seen earlier, tends to also correlated with Swiss. And also a pound as well sometimes, not as strong correlation as the Canadian one, but because we have Brent, the UK oil, pounds also correlate with Brent. Why? First of all, let's explain the Canadian dollar. There is a positive correlation between Canadian dollar and crude oil, positive correlation between US oil and Canadian dollar, but in a matter of the currency pair, so dollar CAD and oil, it's a negative correlation. So let me clear this up. If oil moves up, Canadian dollar will move up as well. But dollar CAD, the pair dollar CAD, it will move down. So stronger Canadian dollar against a weaker US dollar. Is that clear? Hopefully it is. And the reason for that is again has to do with the fact that US is currently, no, always. I mean, Canada is one of the world's largest exporters of oil. The biggest consumer of oil from Canada is United States, and in general, the Canadian economy is highly dependent on the US, as you might know. They consume the 75%. I'm not sure whether this is this as a percentage. It's now higher, but they used to use and consume the 75% of Canada's total exports of oil. And that's why that explains this famous correlation. For example, remember that we spoke earlier about Chinese demand, Chinese economic growth, US economic growth, like the US consumer confidence that we're going to see later on. The data, as I mentioned earlier, remember that they present, it gives us an overview of the economy per country, right? So having a growth having a sign of a growth, let's say on the Chinese economy, let's say, we might have better than expected imports or exports or better than expected confidence or retail sales and etc. This suggests a higher demand for oil for China, for example. Okay, so that could be an event that could possibly affect the oil, and that could have as a consequence the appreciation of the Canadian dollar as well. Okay, so for example, just to see an actual example, U.S. oil. I will put the hourly chart just to show you. Let me just. Oops, no, I want this one. Okay, give me a second. So, for example, last week. Let's take last week's performance. So let's start with this. We had a significant drift last week. Okay, if I remember properly, up to 6% or somewhere there of a decline in the U.S. oil. Why is that? Data affected this drift, by the way. And if I put side by side the dollar CAD as well, we're gonna see that they had the inverse reaction because they have a negative correlation. Once oil is down, dollar CAD is up. Once oil is up, dollar CAD is down. So you see that? Let me just zoom in. Up and remains to the upside, down, but it's steady a bit. Why was that? What happened and impact initially oil down and based on the correlation and on some Canadian data, the dollar CAD higher. It was a lot of commentary from central banks indicating that they're keen to resolve the flood in inflation down, even if that means keeping a lid on demand and activity. Okay, so also it was the Chinese Golden Week holidays. It was so there were some reports actually in Asia about shrinking refining margins in Asia. So that added further pressure on oil because there were reports from the news that refiners are considering reducing production. Okay. And on top of all this, it was the Chinese Golden Week holiday, which tends to have an increased demand of fuel, of jet fuel, and some data that show further strengthening of Chinese economy. So the stronger the Chinese economy gets, the more the demand. Okay, so all these, the repeated speeches that they will bring inflation down, the data from the China that they were better than expected, indicating a strengthening of Chinese economy, and all these things that I mentioned it was from Bloomberg that they flagged the shrinking refining margin in Asia. All this supported, all these initially pressure oil because the commentary from central banks about inflation pressure initially the oil. However, the data from China provided a floor over here to oil. It stopped this decline, but this decline had an opposite impact on the dollar CAD, which rose higher. That was another thing that I wanted to mention. Just to remind you, yes, so this is what, just to remind you that, let's get back to US oil. Yeah, so the decline started 13th of April and was for the full last week, or it was in a sharp dip. The more the suggestions of additional rate hikes, the more the pressure tends to be for the US oil. Okay, because higher interest rates have implied to reduced demand. Okay, but the news from China is where they have put this kind of a floor, at least for now, to this US oil. But the driver over here of US oil was mainly the central banks and the indication that that they will have some additional interest rate increases. What else I wanted to mention over here? Yeah, that was it. And as I said, that we can see very strong correlation because dollar CAD moved on the exactly different direction. You with me so far? Everything okay? So in general, the summary in regards to Canadian dollar and US oil, and oil, not US oil more only, have in mind that when it is believed that global circumstances will result in oil becoming more expensive, then is where we can see a Canadian dollar reacting on a different direction. Also, weather is something that affects and correlates with the US oil and Canadian dollars. For example, a hurricane could force oil production in some parts of the United States to shut down, right? You remember there is a hurricane season. I mean, in August, I think in August. So that tends to have a shutdown in some parts, so a decline oil production. Okay. So once production stops in some places in the United States, there is now less supply of oil. The demand for oil has not decreased, and so the price of oil goes up, resulting in a higher demand for the Canadian dollar, as explained earlier. I have more examples over here as well. You can see that the daily correlation over here is up to 87%, while the intraday one, the 1 hour, is not so strong, is weak. It's more than 70% correlation is considered as a strong correlation. Stock markets or gold with Swiss, we can see over here that I have an example that there were some negative reports from the US, which which has pushed investors to withdraw capital from the US stocks and to move it into safe havens such as Swiss franc or gold. Nikkei and dollar yen over here as well. So it's not a so clear correlation, but it's there. You can see that the appreciation of Nikkei lead to a boost of dollar yen. Okay, while the consolidation of Nikkei and eventually a downtrend was reflected with a sharp decline in the dollar yen as well. And that's where we we have the end of our webinar, guys, where we have seen a lot of examples. For those that they are not familiar with Premium Traders tools, the one that I demonstrated earlier is one of the products that we offer in our Premium Traders tools package. So it shows correlation with in the form of a percentage for any time frame that you might be interested in. Also, we have correlation trader as well, where you other than the how strong or weak the correlation could be, you can also compare. You can see the charts of the both related parties and the related assets. To see the correlation more time frames. So you can see that now I have 2 minutes, 3 minutes, 4 minutes, 5 minutes, 6 minutes, 10, 12, 15. Not only the standard ones in this one, and you can actually place a trade as well in this one. That's the benefit of correlation trader, that in this single window you can compare the two charts, the two assets. You can see their relationship. You can have all these time frames, and you can on spot set a trade, and not only set a trade, but you will be able to see also the profit or loss, margin, lot size, and etc. So yeah, and I need to upload the PowerPoint. Guys, we have reached the end of our with our webinar. So if you have questions, now is the time to say it out loud, to stick it on the question box. In the meantime, until I have any feedback, I will send you the PDF right now. Otherwise, if there are no further questions, I will call it a date. So okay, handout is out. Handout is posted, has been uploaded. So if there are no further questions, I'm gonna call it a day. It's a very straightforward topic and a very useful information that could increase your, other than your risk management, obviously, also your potential. It could limit the risk and increase your profit as well. The knowledge of a strong or a weak correlation, because if there is a weak correlation, you can avoid some trades that you were considering, or if you have a strong correlation, you can trade the correlated markets, could be 2 or more, and benefit from this correlation. Okay, I cannot see any questions. I'm gonna call it a date. Anything you need, we are here anyway. You can find us in social media. I mean, in the HFM Facebook page, HFM Twitter, LinkedIn, YouTube, Instagram, etc. But also is our emails, webinars at hfm.com, and the team or me and Stuart will reply within 24 hours. Okay. So I'm going to call it a day. Thank you very much for attending. Have a great day ahead. Take care. Tonight we have two of the big giants, tech giants, reporting their earnings. Microsoft and Google, Alphabet. And many more. I mean, we have Verizon. We have Visa, if I'm not mistaken. Let me just check the calendar in front of me right now. So you understand that, as I said earlier, earnings reports strongly correlated with the stock market in general, but also the particular company's share. Like, for example, we have seen that FRC reported significant decline in deposits. So that is something that has drift the First Republic shares by 20% down after hours. So we might see on the US Open this kind of pressure for the First Republic share. So yes, tonight we have Microsoft Alpha. Today we have Microsoft Alpha, the Visa, PepsiCo, McDonald's, Verizon. These are the big ones. General Electric, Sage, HSBC, and etc. Okay. So keep an eye on the calendar as well. Okay. Thank you guys. Have a great day ahead. Bye bye.